In this video, I will discuss contingent liabilities, including some typical forms of contingent liabilities, how to manage contingent liabilities, the distinction between provision and contingent liability, and what happens if companies fail to report contingent liabilities. Contingent liability is an important financial term that frequently covers below the surface of a company's balance sheet, representing possible liabilities that could come to pass or not in the future. It is an important part of financial reporting and risk management that can have a big impact on a company's financial health and decision making. Potential future commitments or liabilities that are contingent on specific unpredictable events or situations are referred to as contingent liabilities. These obligations have not yet been confirmed, but they may occur as a result of certain events. It's vital to distinguish between contingent liabilities and real liabilities, which represent obligations that a company must meet. Let us now look at some common types of contingent liabilities. Contingency liabilities can come from pending legal disputes or litigation against a company. These legal efforts may result in settlements or conclusions against the firm. Companies frequently give product warranties, committing to fix or replace damaged items with a certain duration. Until claims are made, the expense of upholding these warranties is a contingent responsibility. A company assumes a contingent liability when it guarantees the commitments of another entity, such as a subsidiary or business partner. If the assured party fails to perform the duty, the company may be considered responsible. Businesses participating in industries with possible environmental liabilities, such as pollution or hazardous waste disposal, may suffer cleanup and remedial responsibilities. Tax disputes and audits can result in contingent liabilities if the outcome results in a company owing additional taxes, fines, or interest. Understanding and managing contingent liabilities is essential for a variety of reasons, including companies must report contingent liabilities in their financial statements, often in the balance sheet footnotes. This transparency is required for investors, creditors, and other stakeholders to appropriately assess the company's financial health. Potential financial risks are represented by contingent liabilities. Companies must carefully evaluate these risks in order to make educated decisions about future investments, finance, and overall business strategy. Contingent liabilities can have a negative impact on a company's credit worthiness and ability to obtain loans or credit lines. When analyzing a company's financial viability, lenders and creditors take these possible responsibilities into account. Companies should consider the following ways to properly manage contingent liabilities. Monitor and appraise prospective contingent liabilities on an ongoing basis, including their risks of occurrence and financial impact. To reduce potential liabilities, use strong legal and risk management procedures such as installing safety measures, negotiating helpful contract terms, and maintaining insurance coverage. To offer stakeholders with complete and accurate information, clearly disclose all relevant contingent liabilities in financial statements and footnotes. Make provisions or reserves to cover anticipated future liabilities when they become more likely or reasonably estimable. How do we distinguish between provision and contingent liability? Provisions are sums of money set aside to cover a potential expense that will occur in the future. The obligation is already existent in this scenario, but the specific amount for such an obligation cannot be calculated. Contingent liabilities are liabilities that are unpredictable expenses that may or may not occur in the future, but that businesses keep in order to deal with future uncertainty. Provisions are recorded in the financial statements. They are deducted from profit and loss statements. Various contingent liabilities are reflected as footnotes in financial statements. Failure to report contingent liabilities can have a number of legal and financial consequences that have a substantial impact on a businesses. Here are some examples of possible outcomes. By failing to register contingent liabilities, a company's financial statements give an incomplete and potentially misleading picture of its financial health. This can have an impact on the decisions of investors, creditors, and other stakeholders that rely on reliable financial information to determine the risk profile and performance of the organization. Certain types of contingent liabilities may be required to be disclosed by law depending on the jurisdiction and regulatory environment. Non-compliance with these regulations may result in penalties, fines, or legal action being taken against the company and its management. Lenders and creditors might not fully understand the company's financial responsibilities. thus compromising the company's credit worthiness. This can result in greater borrowing cost or difficulty obtaining finance. Contingent liabilities are prospective hazards that should be actively managed by a company. Ignoring these risks can lead to unforeseen financial obligations if and when the contingent liabilities appear. Failure to disclose contingent liabilities appropriately may reduce investors' trust and confidence in the company's management. This lack of confidence can have consequences that last for the company, making it more difficult to recruit investment and support. When contingent liabilities are eventually recognized, whether as a result of actual events or changes in the likelihood of occurrence, they can cause unfavorable market reactions, such as a decline in the company's stock price. If a company is involved in merger and acquisition activities, potential acquirers will conduct due diligence to assess the target's financial health and liabilities. Failing to disclose contingent liabilities can complicate M&A, merger and acquisition negotiations, and potentially reduce the sale price. Financial audits are performed on companies, and auditors are responsible for determining the correctness and completeness of financial accounts. Failure to disclose contingent liabilities can result in audit difficulties, such as negative views on the company's financial statements. Contingent liabilities are a natural element of the business world, indicating possible financial commitments that can have an impact on a company's financial stability, decision-making, and risk profile. Understanding these hidden risks and managing them successfully through accurate assessment, risk mitigation, and honest reporting is essential for any business's long-term performance and sustainability. Thanks.